I mean, the biggest one, by far the most dominant, is the expectation of reflation, of a growth rebound. And that's fueled primarily by this unprecedented amount of stimulus. And you have almost 25% of GDP, or the size of the economy, is already hit, and more coming. You know, the consumer is in good shape. There's a lot of pent up demand. And at the same time, you have the Fed kind of priming the pump with kind of an unprecedented amount of monetary stimulus. And the main trigger is just the reopening of the economy. The vaccines are getting distributed. So all this translates into very strong economic growth. So the impact of all this has been, higher rates, a little bit higher inflation expectations, and also a very strong equity market. The market has already priced in some of this, but we think there's more room to go. So what's our view of inflation? Inflation already is rising and will rise to the highest level in years. And that's partly because of what are called base effects. In other words, inflation was low, prices fell last year. But a lot of it is this surge of demand that's driving prices higher. You're seeing not only higher demand for goods, but also supply shortages that kind of came out of the pandemic. Now, our base case is that inflation rises. There is a risk, however, that it rises significantly and more than the Fed is expecting. We think this economic cycle will be shorter and hotter. The Fed adopted a new policy last year that is allowing inflation to run hot. And right now, they're trying to get inflation to exceed their target of 2%. They're going to hold at zero longer. They're not going to react until actual data, and they're not going to react as inflation goes over 2%. I think that increases a tail risk that inflation gets out of hand the longer they sit. The more the chance that they miscalculate and inflation takes off later in this cycle. One of the primary factors of higher inflation expectations and a strong economy are higher interest rates. So we've been expecting higher interest rates for a while, heading into the year. I was thinking maybe 1.5% to 2%. I think we will take a run at 2% at some point this year. Within fixed income, we're short duration. In other words, we have less interest rate sensitivity. That means underweighting high quality fixed income like treasuries, like investment grade corporates that are more sensitive to rate moves, and overweighting lower quality fixed income. So high yield leveraged loans, which have floating interest rates, so they're insensitive to rate moves. And then within equities, it also has an impact in that, primarily it's associated with rotations within styles within equities. So that's had a significant impact on how we position within equities along with fixed income. So what are our expectations on interest rates? In a nutshell, higher. They've already moved up fairly significantly. But over time, I think the risks are very asymmetric for higher rates driven by the economy, strengthening the economy, and all this pent up demand. So what that means is that we also expect the curve to steepen over time. It's already steepened a fair amount, but we think there's more room for the curve to steepen. And eventually, once the Fed decides to start raising rates, it'll flatten. What are the risks to the market if rates go up? It really kind of depends on how they go up. What the market fears most is kind of a rapid, disorderly rise in rates. If the rise in rates is more orderly, you can see a sharp increase over a short period of time, and then it kind of flattens out. Then the markets do very well because there's a strong correlation between rates and the economy. If the economy is doing good, generally equities are also going to do well. And the same thing for credit within fixed income. Rates are a threat or negatively impact treasuries and returns of high quality. But the lower quality, the higher the yield you get, the more ability they have to absorb and the more sensitive they are to economic conditions. So credit also generally does well. So overall, we expect the market to be able to digest this rate increase over time. And the signal that it's sending that the economy is strong is something that fits well with a strong equity and credit market over time. We are overweight domestic currently by a reasonable amount, moderate amount. We have been that way mainly because if you look at how the U.S. has done over the past year, they've spent more fiscally, the stimulus money, but we're also ahead as far as vaccine distribution. That's one thing that stands out right now. And what that does is it enables the economy to reopen. And fundamentally, the U.S. also just has stronger secular earnings. That said, I think international parts of it are looking more interested. We're underweight overall. I think developed markets are appealing right now. We have increased our position within developed markets, other international, such as Europe and Japan, and lowered it with the EM. And what we like about Europe in particular right now is they were struggling through the pandemic a bit. They did less fiscally. They were locked down more than we were. And they were a little late to the game on vaccines. They didn't procure them early enough, so they're behind on inoculating their population. But that will change. And as the U.S. gets going too, that'll help propel global growth. And if you look at what drives Europe, they're much more sensitive to trade and to global growth. So we have upped that and expect Europe to do well. And if you look at earnings expectations for the rest of the year, they're higher in Europe than they are for the U.S. EM, we remain underweight. And there are several reasons for that. They struggled more with COVID. They still are parts of EM. They have a lot of debt that they incurred, some of it via response to COVID. And then they're also much more sensitive to higher US rates. That can be a bad thing for EM debt that's denominated in US dollars, and a strong dollar would also be a challenge for emerging markets. I think time will come to overweight emerging markets because they are levered to global growth, but currently not right now. So the US incurred a lot of debt responding to the pandemic. All the fiscal stimulus was funded with debt, funded with treasuries. And debt has shot up to near record levels, almost to kind of World War II levels. But I think that was what needed to be done at the time. You needed to prevent a depression. You needed to prevent the economy from spiraling out of control. And it makes sense too, because rates were at record lows. So as long as you can grow your economy faster than the interest rate you're paying, you're in essence deleveraging. That said, long term, this is an issue. It'll burden future generations. Should interest rates go up materially, that'll impact our ability to service the debt and crowd out other items from the budget. It might mean higher taxes over time, and in general, be a burden on growth. So that is something that we watch closely. It's just not an immediate concern. And then if you look at other parts of the economy, as far as debt generally, the consumer's in great shape. Actually, the consumer paid down debt in aggregate through the pandemic. There was a fair number of people who used their stimulus checks to pay down debt. And corporate America is also a bit of a concern. They have record levels of debt right now. A lot of companies borrowed during the pandemic, but it's something that we're somewhat concerned about as far as when you look at credit, investment in corporate market, high yield market. They need to follow through with that. Interest rates are very low, and that's caused a lot of people to kind of think about the mix of fixed income and equity, particularly the standard 60-40 portfolio. And the 60-40 portfolio over the last 20, 30 years has actually worked very well. But you got to remember that that's been in a secular bull market for rates. Rates have fallen, and now they're near record lows still, and rates are likely to go out. So that's caused us to kind of look at that and assess long-term strategy, which we're currently in the process of doing. So what are some of the responses to that? Well, you can overweight equities. The returns are going to be greater with equity. Stocks would have to return about negative 20% for bonds, treasuries to outperform. The problem with those, you get increased volatility. So the more equities you have, the more volatility you get. I think we feel comfortable overweighting equities now. The economy is strong. I think internationally, the valuations are more attractive, and particularly EM. It should grow greater than the US in the long run, and maybe you would tilt a little more to international. And then within fixed income, you would underweight interest rate sensitive areas more, so less on treasuries, less on high quality corporates, and a little bit more on lower quality, high yield leveraged loans. But you need to be a little careful about taking this too far because treasuries rates are still over time going to be negatively correlated with equity returns. So I still think there's a role for fixed income and a role for treasuries in a portfolio to help dampen vol and be counter-cyclical. But overall, I think you need to tilt a little bit more aggressively given where rates are right now. One of the things that we have seen this year within the market, the equity market, are very strong kind of style rotations. And this really was triggered last fall is when it really began in earnest. And it was the announcements of the vaccines, clarity on the elections, and the expectation for fiscal stimulus. The main one has been growth to value. And when you tend to see growth do really well is when you're more in a steady cycle and earnings are not taking off. So that has happened. Value has outperformed significantly this year, and particularly if you go back to November. And that ended a string of outperformance by growth of over 15 years. And our expectation is this will continue to happen. If you look at the typical cycle, value usually outperforms for somewhere on the order of about 3 years or so. And value still looks relatively inexpensive compared to growth. And one of the reasons that growth gets hit too is it's very rate sensitive. So if you think about a growth stock, a lot of what is you're buying are earnings in the future, and that is where interest rates impact it more. The other strong rotation that has taken place has been from large to small. That happened in a very compressed time. Small has outperformed. I think there's still room for that to happen, but it's a little more fully valued than value is at this point. Within Thrivent Asset Management, we are overweight small and mid cap a bit. We have added to small, and we also have added to the extent that we can to the value trade. And so our expectation is that this year cyclicals will do very well. Financials, materials, energy to a certain extent, industrials. If you look at tech right now is pretty richly valued, and it's also much more sensitive to higher rates. Tech has corrected a little bit, as we talk now, and it looks a little bit more attractive. And over the long run, absolutely, tech is a good thing to hold. It's got secularly stronger margins and stronger growth prospects. Tech faces potentially a lot more regulation. It will come under scrutiny, including antitrust scrutiny, and specifically within healthcare. Pharma also faces potential pricing controls on it as the government pushes back on the rapid rise in drug increases. We do expect rates to go higher over time. It'll be choppy. It won't be one way. So we are short duration. In other words, we have a less interest rate risk than our benchmarks, and also offer kind of some lower interest rate, less interest rate sensitive funds. And more broadly within fixed income, that means overweighting lower quality or higher yielding areas, which tend to be a lot less responsive to higher rates because they have higher yields. And the other thing that we're doing is, looking more toward what we call alternatives. MLPs, master limited partnerships within energy, particularly pipeline companies, offer very attractive yields. Business development companies, and these are all higher risk, so you get more volatility, but we feel comfortable with the overall trajectory of the market and the economy to take those risks. Yield is a really interesting question within fixed income because we're off record lows, but we're very close to record lows. So how do we deal with that? We tend to underweight very, very high quality fixed income, treasuries, ones that are yielding low, investment grade corporates. We still have a place in a portfolio, but we tend to underweight that versus higher yielding areas. And in particular, that is high yield. You can still get close to 5% in parts of the high yield market. Leveraged loans is an area that we also use extensively throughout our mixed asset funds. And they have a yield close to high yield and sometimes even more, but they're also pay floating interest rates. So they are less sensitive to higher rate. Emerging markets also offer more yield. You need to be a little careful there, however, because they tend to be very long duration. And more generally, we've been looking toward alternatives, looking out at traditional fixed income for areas where we can get yield. And specifically, we've been using closed-end funds and MLPs in the energy space. These are master limited partnerships, and also business development companies still offer kind of high single digit yields. Again, these are going to be more volatile than traditional fixed income, but it is a place and can play a role supplementing more traditional areas of yield. One of them is valuation, particularly in the U.S. markets. Should the U.S. markets become richer, we would tend to lean more internationally then. Valuations are rich, but we think that the market will grow into it. Valuations are also a concern within fixed income, particularly credit. If you look at credit spreads, they are very low, not near record lows, but are getting there. So the compensation that you're getting for taking extra risks in fixed income is getting lower. We still think it's worth it in a world of low yields, but it's something we're monitoring closely. And should it continue to get significantly richer, we would probably pivot away from lower quality fixed income. The other main thing is evidence that the economy is not meeting expectations, that the growth that was expected and the very, very high growth expectations, that is not coming through for whatever reason. And primarily, the main trigger for that would most likely be COVID. If the vaccination uptake is below expectations, then that would delay potentially wider reopening. But more importantly, we watch variants very closely. If there are variants of the coronavirus that get around vaccines or cause serious illness, that would cause us to reassess our positioning. On the flip side of a stronger than expected economy, if that triggers a disorderly rise in rates, that might cause us to pull back on risk, or if we thought that the Fed was in a position where they needed to raise rapidly and sooner than expected, most likely triggered by inflation that is higher than anyone's expectations. So that's another thing that would cause us to pull back in risk and that we're watching closely.